Well, we want to welcome Kirk Chamberlain, our national construction practice leader here at Hub. Wanted to sit down and talk really quickly about a term and a topic that we hear thrown around in the construction insurance industry recently, and I think it's new to a lot of people, and that is build to rent. So, Kirk, what the hell does that mean?
Build to rent. So it is probably the fastest growing asset class in the residential space today. Most of our builders, and we read a lot of builders, most of our builders are pivoting into that. A lot of the private equity firms and institutional investors that we work with are also pivoting into that. A lot of that's being driven by the demographic shift that's happening. A lot of younger people, probably a little younger than you and me, but 20s, 30s folks, either can't afford a downstroke for a home, so they don't really have an option to buy. Just as likely nowadays, though, it's a lot of those guys don't want to be tied down to a mortgage. They recognize the job market's super mobile. They want to be mobile, and they want to be able to pop around and move and not be tied down to a home. So, but they want to have a home. They want to have a yard. They want to have all the trappings of a single-family home in a suburban kind of community.
Could this apply to townhomes?
It can. It does. The phenomena, the really interesting phenomenon, though, is it's historically it was mostly detached, semi-detached, so townhomes, patio homes, that sort of stuff. That was fairly common, and obviously multifamily apartments and things. What's different now is the fact that this is starting to migrate into traditional single-family homes, like a subdivision you drive into and see your neighbors walking their dog down the street.
Got it.
A lot of that stuff's being rented out now and not sold.
So from an insurance perspective, what would be the difference in placing coverage on a build-for-rent single-family home community versus perhaps tract homes that we do for one of our big home builders?
Yeah. So short answer is it's substantially different from a risk perspective, but also the market. So the traditional insurers that write this stuff, it's a lot of the same players that would write the for sale single family. So the traditional home builders, traditional developers. Problem is the risk is different, right? It's got aspects and attributes of rental, but it looks and feels like a single family home. So it's not one or the other, it's a little mix of both. And what we're finding is that the traditional markets that have historically written either rental or for sale single family, neither one of those models fits particularly well with the build to rent. And that's really where the problem arises, and in our view, kind of the opportunity to step in and start experimenting and doing some things a little differently. Got it.
Any other tips that you'd give perhaps a prospect or a home builder out there that's going to venture into the build-to-rent space? Obviously, we at Hub know this space. We've done it quite a bit already. Yep. But is this something that they should maybe reach outside from the traditional avenues that they've been buying insurance from and give us a call? Or it just seems like we have the expertise and been doing it quite a bit lately.
Yeah, I mean, we got kind of pulled into this, frankly, probably not intentionally, but inadvertently early by a lot of our builders. Again, we're very big in the traditional home building space. A lot of those builders were starting to pivot out and pivot into this build to rent. So we've sort of stumbled into this, frankly, accidentally a few years ago before it really blew up. And, I guess my advice would be careful about approaching it. And, if we're having a conversation with an investor or builder, right, be a little careful about approaching this the same way we approach for sale, because it's a different risk. Again, the way that the reflexive way that brokers want to write this is rental product, right? Like an apartment. Fine, it's cheaper to do it that way in some cases, but what you've done is you've set yourself up to create some other problems a little further down the road with respect to how that policy is going to respond to things like construction defect if that asset, that home, is ever converted to for sale. Mm-hmm. If it is, you're SOL in many cases. So you got to be really careful and go in and very intentionally address that risk up front. Yeah. And that's a lot of what we try to do up front.
Yeah, our first exposure to the build to rent was actually on the stabilized side. There were things that were already coming off builders risk and off their OSIPs, CSIPs, and we learned very quickly that it's not your traditional placement. You got to know how these things are structured and how they're put together and what the future plans are for them. So I think it's good that from the construction aspect, we get to hear it from the GOAT.
Well, full transparency, I don't think anybody's really figured this out yet. We have an opinion, and we've done enough of these that we certainly know how not to do it. So I think we're getting better at it. But and honestly, that's part of the opportunity for us. We view it as a competitive advantage for us, but we're also trying to kind of drag the market along with us and try to figure out if there isn't a better way to do this. Skin this cat, right?
Love it.
So
awesome, cool.